All right, hi everyone. Welcome to today's webinar brought to you by Vantage. Right, today we're going to be looking at how can we trade interest rate decisions. Right, just want to let you all know we're streaming directly into the Vantage app as well as over Zoom. So do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. Right, before we begin, please take note of the disclaimer. Right, the information, context, and opinions which expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs as they carry significant risk and is not suitable for all investors. Right, my name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between Vantage and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so here's the agenda for today. So we'll take a look. We'll start off with the basics, of course, take a look at what are exactly interest rates and who controls them and why they are important, and also how can they impact financial markets as well. And finally, we'll move on over to how we can trade interest rate decisions as well as which are the freely available resources at our fingertips. Right, so what are interest rates and who controls them? Right, so basically at its simplest form, right, interest rates are the bank rates that are charged to domestic banks to borrow money. Right, banks then provide loans to institutions, businesses, households, individuals at a higher interest rate to earn income on the spread, which is otherwise known as net interest margin or NIM. Now, this net interest margin is the primary way where commercial banks make money. Now, what are some of the exact types of loans that are available? Right, of course, we have business loans, mortgage loans, personal loans, as well as credit loans. Now, how are all these interest rates levels determined, right? So basically, it starts off with the nation's central bank. They're the first starting point, and they will set the interest rate to implement or signal its monetary policy stance. Now, if a central bank is hiking rates aggressively or keeping rates elevated, they are deemed to be hawkish. And conversely, when a central bank is aggressively cutting rates or keeping rates at very low levels, right, or very suppressed levels, they are known to be dovish. Now, which are the key central banks around the world? Right, there are many central banks around the world, but of course, the Federal Reserve is the most influential and most prominent central bank. Right, the Federal Reserve from the United States is also known as the Fed, and we've also got the European Central Bank, the ECB, Bank of Canada, Bank of England, Bank of Japan, uh, Reserve Bank of Australia (RBA), Reserve Bank of New Zealand (RBNZ), and of course, Swiss National Bank (SNB). Now, of course, there are other central banks from around the world as well, but these are the uh, primary and key central banks that would be that would have a major impact on financial markets as well. Right? You'll see more direct impact from these central banks in general. Now, how do interest rate decisions impact markets? Right. Well, first of all, right, as I mentioned, right, the most influential and prominent central bank in the world is the Federal Reserve. Now, what is the purpose of the Fed? Right? Why have they come into existence? Well, basically, they are tasked with maintaining a certain level of stability within the US financial system by promoting economic and employment growth through the implementation of changes to interest rates. Now, the Fed sets two types of rates: target interest rates and a discount rate. The target interest rates, otherwise known as Fed fund rates, are the rates at which banks lend to each other overnight in order to maintain reserve requirements. Now, the discount rate is the rate at which banks can borrow directly from the central bank. Now, when the Fed is talking about its target range, right, it is referring to the Fed funds rate. Right? So currently, the Fed fund rate stands at 4.25 to 4.5%. Now, the Federal Reserve, just like many other central banks, have limited tools at their disposal, and their main primary tool that they have is to either cut interest rates or raise interest rates. And another tool that they have is to embark on quantitative easing, otherwise known as QE, or if they've rolled out quantitative easing, the other step that they can take is to tighten, and that's called quantitative tightening or QT. Now, at its most basic form, right, if the Fed raises interest rates, it increases the cost of borrowing for everyone, right, for institutions, businesses, households, and individuals, making both credit and investment more expensive. And typically, this is done to slow an overheated economy or to bring inflation under control. Now, if the Fed is lowering rates, it makes borrowing cheaper naturally, right, which encourages spending on credit and investment. And this is typically done to help stimulate a stagnant or slowing economy. Now, what are examples of overheated economies in recent times, or rather over the last 25 years? And we've had asset bubbles in 2000, 2001, right, the dot-com bubble. We also had real estate mortgage bubble in the US in 2007 to 2008. And also, of course, as recently as 3 years ago, we were in a high inflationary period uh, beginning in 2022. Now, we can see here, right, in March of 2022, the Fed started to raise rates aggressively, bringing it up from 0.25% to as high as 5.5% by the second half of 2023. And they kept rates elevated all the way till the third quarter of right? So in the final quarter of last year, beginning just before the final quarter, beginning in September, the Fed moved ahead with its first rate cut, and they proceeded to make two more consecutive rate cuts by the end of 2024. However, since then, when we've seen the Fed maintain rates at current levels, and we'll come to that in a while, why the Fed actually began with cutting rates at the end of last year. However, they've uh, become less dovish and decided to adopt a wait and see approach in 2025. Now, the most recent meeting for the Fed took place in June, just about 1 week ago, right? Where they maintained the Fed funds rates at 4.25 to 4.5% for the fourth consecutive meeting, as they take a cautious stand, right? Because we've seen the impact of tariff announcements by the White House and by President Donald Trump. They have completely uh, murky the outlook on global activity, global trade, and that has caused a lot of issues, not only for the US, but of course for everyone else in the world, right? So particularly those related to tariffs, immigration, and taxation. Now, although in the most recent statement, the Fed has stated that, or has noted that, although the uncertainty about the economic outlook for this year and beyond has diminished, but it still remains elevated. And the Fed continues to project two rate cuts in the second half of this year, right? While it is only anticipating one rate cut in 2026 and another rate cut in 2027, both of which would be 25 basis points each. Now we can see here, right, the Fed is not very dovish at the present moment, but that could all change, right? If we do see global growth deteriorate even more, and especially if US labor market and consumer spending takes a big hit, we are likely to see those rate cuts accelerate. But for now, things are still holding up, right? So the Fed sees no reason to move ahead with aggressive rate cuts in 2025. Now, they've also downgraded its GDP forecast for 2025, down from 1.7% to 1.4%, and for 2026 as well. Unemployment rate is projected to be higher in 2025 and 2026. Now currently sitting at 4.5% versus 4.4 and 4.3% previously, based on previous um, projections. And as for inflation, right, they are expected to see inflation remain persistently elevated, right, or stubbornly sticky, with PCE inflations coming in at about 3% in 2025 versus the earlier forecast of 2.7%. Right, and for 2026, they're expected to see PCE inflation coming in at about 2.4% and 2.1% in 2027. Right, so part of the reason for Fed staying put is also inflationary pressures accelerated towards the end of last year and in the first quarter of this year as well. Or this first quarter of this year, maybe they did not accelerate as much, but they will definitely uh, remain elevated and well above the Fed's inflation target of 2%. Now looking at CPI, right, we can see here since its peak of 9% pretty much back in June of 2022, inflation has decelerated quite strongly. Right? CPI, as you can see on the left, we have the chart for headline CPI, and on the right, we have the chart for core CPI. So headline CPI has decelerated quite sharply, dropping as low as about 2.4% back in the middle of last year. However, in the last quarter of 2024, we saw inflation accelerate, right? We saw headline CPI accelerate, rising to as high as 3.2% by January of this year, before finally easing once again. So this little acceleration in headline CPI, along with other factors, had caused the Fed to adopt a wait and see approach as 2025 kicked off. Right. Similarly, core CPI had also eased significantly, dropping from about 7% all the way down to about 3.5% in by the end of last year. Right. However, in the final quarter, we saw core CPI remain persistently sticky as well. It did not accelerate as sharply as headline CPI, but core CPI remained relatively stubborn and was not making any progress. PPI as well, right? We can see both headline PPI on the chart on the left and core PPI, which is a chart on the right. We can see both of them decelerating quite sharply at the end of 2022 and for most parts of 2023. However, we've seen both of these indices start to accelerate once again, mostly throughout 2024. However, now we're starting to see some deceleration start to gain traction. So you can see how rising headline CPI, persistent core CPI, combined with rising headline PPI and core PPI, right, put the Fed in a wait and see stance as they wanted to see how inflation would evolve, right? And especially after April, right? April 1st or April 2nd, sorry, was Liberation Day. That's when the White House announced a barrage of tariffs against its major trading partners, with the U.S. major trading partners of the U.S. And that had turned the whole outlook upside down, right? The Fed's outlook was completely turned upside down overnight with those announcements, right? As global uncertainty increased, volatility surged, and we saw a huge sell-off not only in equity markets but in the bond market as well, right? There was a huge turmoil between March till mid-April, and as progress was made with regards to tariffs related talks and negotiations, right, that has sort of brought some calm back into the market, and we've seen equity markets rebound very strongly. However, inflation continues to remain somewhat elevated and sits well above the Fed's target of 2%. If you look at headline CPI, with the latest reading for May being released last week, coming in at an annual rate of 2.4%, while the core CPI coming in at a slightly higher level at an annual rate of 2.8%, right? Both of these readings are well above the Fed's target of 2%. Hence, they are in no rush to continue with an aggressive rate cutting cycle in 2025. But despite that, right, we've seen actually the US dollar drop quite sharply, right? We've seen the value of the US dollar sink versus all its peers, and we can see that being reflected in the level of the dollar index, right? The dollar index has lost nearly 12% this year as global trade uncertainty caused global investors to lose faith in the value of the US dollar, to lose faith in the value of US treasuries, and that has caused the bond market and the US dollar to sell off quite aggressively in 2025. Right, so despite the Fed actually holding rates in 2025 and adopting a somewhat neutral outlook, we've actually seen the US dollar continue to slide lower while bond yields remain elevated. Or rather, treasury bond yields in the US remain elevated as well. Now, how can we trade them? Right, first of all, we take this from the perspective of the Federal Reserve. So, of course, we need to know which are the dates where the FOMC meeting is taking place. So, if you head on over to this website here, Federal Reserve Monetary Policy and FOMC calendars, we can get the full calendar for 2025. And once each meeting has concluded, we will also be able to view and read the press statements, as well as rewatching the press conference, and for meetings that are associated with a summary of economic projections, we are also able to read that report as well. Right, so you can see here the last meeting was conducted on 17th and 18th of June, right? That was just last week. And the next meeting is coming up on 29th till the 30th of July. So you can see at each of the first four meetings in 2025, the Federal Reserve has kept rates on hold between 4.25 and 4.5%. Right. So there are also key macroeconomic events to watch out for, right? Besides changes in interest rates decisions, we also need to look at deviation from normal monetary policy action, such as central bank intervention. Now, central bank intervention is something, it's a policy action that has been practiced aggressively by the Bank of Japan in recent years. And when we can identify potential divergences between monetary policy, potential divergences in monetary policy between two central banks. It also helps us identify like the most profitable trade as well. So we'll take a look at this later on, just slightly in the next few slides. Now, changes in inflation growth can also impact um, the outlook for the central bank, right? So as we saw, inflation start to rise sharply towards in the second half of 2021 and started to rise even further, accelerate even further in 2022. We saw not only the Fed, but many global central banks around the world hike their interest rates aggressively in order to try and tame inflation, to try and bring it under control. Right? Of course, changes in economic growth, such as looking out for GDP figures, PMI reports, non-farm payrolls, which is labor market data, and inflation, of course, is all going to impact how the Fed is going to adjust its monetary policy stance. Now, talking about intervention, this is important as well. As I mentioned, the Bank of Japan is no stranger when it comes to carrying out intervention measures in the open market. So typically when the Bank of Japan intervenes in the open currency markets, they're basically selling the US dollar. Well, first of all, they're basically selling their foreign holdings, right? Foreign reserves, which is basically made up of the US dollar and US treasuries. And when they do that, the sales of those proceeds are then used to buy back the Japanese yen in the open market. Now, they would do that if they feel the Japanese yen has devalued a lot and they need to support the yen, right? So as we saw in 2022 onwards, as the Federal Reserve was aggressively raising rates, the Bank of Japan kept its key policy rate at negative 0.1%. So in this period of 2022 to 2023, we were in a period where one central bank, the Fed, was aggressively raising rates, while another major central bank, which was the BOJ, kept its key policy rate at negative 0.1%. So you have one hawkish central bank versus a very dovish central bank. And the currencies involved are the US dollar and the Japanese yen. So naturally, we'll be looking at the currency pair dollar yen, and that had caused dollar yen to surge in 2022. So back then, right, by September, October, the yen had already weakened to 32-year lows, right? Think about it, this is 32-year low. So it had depreciated significantly versus the US dollar. And when this happened, it was suspected at the time that the Bank of Japan had indeed intervened in the open market. Now, when intervention measures take place, right, the Bank of Japan will not officially announce it, but they will. We will see that price action being reflected on the charts is clearly obvious, and within a couple of weeks or maybe even by the end of the month, right, we would see sometimes we would see an official statement being released by the BOJ to say that they had taken part in intervention operations, but sometimes they may not come up with an official statement as well. But one thing is for sure, we will definitely see any suspected intervention measures uh, being reflected in the price action of the charts. And typically in this case, this would be between the US dollar and Japanese yen, right? Otherwise known as the dollar yen. Right, so you can see here several news articles, right, from Reuters till which one is this? I can't remember. Oh, Reuters as well, right? Highlighting, reporting on the latest intervention measures by the Bank of Japan. Right, and they also did another one as recently as 2024, right, nearly about a year ago, where back in May, right, or end of April, May, they spent nearly 23.6 billion US dollars to buy back the Japanese yen to try and support it as well. Now, target rate probabilities, right, we can also have an idea of what the Fed is expected to do based on uh, this website by CME Group. And you have the Fed Watch tool where it calculates the target rate probabilities for each FOMC meeting. Now, the next FOMC meeting concludes on 30th of July, and with the current rate sitting at 4.25 to 4.5%, which is here, we are expected to see right now, or not expected to see, but right now, the probabilities stand at 81.4% for the Federal Reserve to maintain rates at 4.25 to 4.5%. However, there is a growing or rising probability, now standing at 18.6%, that the Fed will make a 25 basis point reduction. Keep an eye on this website here because these figures or these probabilities are updated quite regularly. I believe I think it might be on a daily basis. If not, it might be on a weekly basis that the target rate probability is updated. So at least it gives us a sense of what the Fed is expected to do going into each meeting as well. So if you head on over to this website, right, you can find out or look at the current target rate probabilities for July's meeting as well as for subsequent meetings as well. Now we will touch on the dollar index because this is important as well, right? Because it's a tradable instrument on the platform, right? It's also important to know what is the dollar index and what does it consist of, right? The dollar index, as its name suggests, is an index, right? It's not a currency, it's not a currency pair. It is an index which measures the value of the US dollars versus its peers. And in this case, the peers in this basket are the euro, Japanese yen, pound sterling, Canadian dollar, Swedish krona, and Swiss franc. So we can see here the euro makes up nearly 58%. The yen makes up nearly 14%. So you can see here just these two currencies alone make up nearly 72% of the entire basket. And what this also tells us is if we see the dollar index rising very sharply, not only does it indicate that there's a very high demand for the US dollar, it also means that the euro and yen are selling off very aggressively as well. Because since they make up 72% of the basket, it's very likely you're going to see the largest impact with these currency pairs, or with these two currencies. Of course, pound sterling, Canadian dollar, Swedish krona, and Swiss franc would also be depreciating versus the US dollar if we see the dollar index rising rapidly. However, I think the largest changes are likely to be observed, or the biggest changes are likely to be observed versus the euro and Japanese yen in general, right? Conversely, if the dollar index, if the value, or sorry, if the level of the dollar index is dropping rapidly, it means the US dollar is out of favor. Now, this is something that we are seeing in 2025, right? Especially since mid-January, we've seen the dollar index lose nearly 11.5%, if I'm not mistaken, right? Almost 12%. It has lost in value since the middle of January. Now, where the dollar index is uh, uh, heading lower, it signifies intense sell-off for the US dollar. So of course the US dollar would be underperforming all these currency pairs. So that means we would be seeing Euro USD rising sharply. We would be seeing dollar yen falling sharply. We would also see pound sterling rising up, while cable pound dollar rising up, dollar CAD rising up as well, and so dollar CAD falling, sorry, and so on and so forth. Right. Okay. So these are the resources here that are available. So please take a screenshot. Right. We can get also head on over to Forex Factory and take a look at calendar to find out the upcoming data that's available on the week. So not only would this give you central bank announcements for the US for the Fed, but also the other major central banks as well. Now, and also you can head on over to the Federal Reserve's website as well, monetary policy website, and you can find out the FOMC calendar for 2025 and for past years as well. And of course, you have the CME group with the Fed Watch tool, which gives us the target rate probabilities. We also have the ECB's website where we can find out more about the monetary policy statements and press conferences, Bank of England, Bank of Japan, and so on and so forth. All right, now let's move on over to the charts and trading view and see what we can expect to happen at the next FOMC meeting, right? Remember, the CME Fed Watch tool, if you go to it, Right, this is the Fed Watch tool here, so you can see here. Not only does it give you the target rate probabilities for the most immediate meeting, which is concluding on 30th of July, we also have the target rate probabilities for 17th of September, the meetings concluding on 17th of September, 29th of October, and 10th of December. Right, so it tells us exactly, or not exactly, but gives us a very good idea of what the Fed is expected to do at each upcoming meeting. So you can see here, 430 with the Fed projected to make just 2 rate cuts for the second half of this year, right? It's still very likely that come July, the Fed is going to maintain rates at current levels, and where they could perhaps make the first rate cut looks to be being priced in for September, right? So September, we have a 71.3% probability that the Fed will reduce the target rate by 25 basis points, bringing it down from 4.25 to 4.5 to 4 to 4.25%. So you can see the first rate cut is expected to take place in September. And then in October, we can see a 50% probability at the present moment to see another 25 basis points reduction. And then in December, they are likely to maintain rates at current levels. Or okay, it's almost equal probabilities between keeping rates whole or making a third consecutive rate cut. Right, but for now you can see here very likely September is going to be a whole. Sorry, July is going to be a whole, and September is very likely where we're going to see the first rate cut of 2025 take place. Right, unless of course uh, the macroeconomic conditions deteriorate very rapidly between now and end of July, right? Unless something drastic like that happens, we can expect the Fed to actually hold rates once more. Now, coming back to dollar index, right? You can see here since mid-January, this index has lost, right, 11.4% from peak to trough, right, with the lowest peak, lowest trough or most recent trough being formed at mid of June, right? So, and what is also interesting to note is, remember, the Fed started cutting rates from September onwards in 2025. So if we look at the dates, right, 18th September, we look at, oops, no, 18th September, 7th November, 18th July. Now, if you look at these 3 dates, right, 18 December, 7 November, 18 September, 7 November, 18 December. These were the dates where the FOMC meetings had concluded and the Fed had actually cut rates. At the meeting on 18th of September, they made a jumbo rate cut of 50 basis points. And in the subsequent meetings, they made a 25 basis point reduction in November and December. Now, this runs counterintuitive, right? The price action of the dollar index runs counterintuitive to what the Fed had actually done. Remember, in each of these 3 meetings, the Fed had actually cut rates, which would mean that the dollar should be seeing less demand, which would also mean that bond yields should be falling as well. However, US Treasury bond yields actually started to rise, and the value of the dollar also started to increase as well. Demand for the dollar picked up significantly, causing the dollar index to rise rapidly as well. You can see the dollar index from its lows of September last year actually rallied as much as 10%, right? And this is in spite uh, or despite of the Fed making 3 consecutive rate cuts, especially with the one here on 18th of December, moving ahead with a 50 basis point reduction. Now, why would you think that the value of the US dollar actually increased? Treasury bond yields actually increased when the Fed was cutting rates. Now, all this during this period here is when we saw inflation start to accelerate in the US, specifically with headline PPI and headline CPI both accelerating quite noticeably. And at the same time, we also saw the labor market stabilize and start to show pretty good job growth with regards to the ADP employment reports as well as the non-farm payrolls report. Now, what happened prior to that, between June and September, during this period here, June and September, during this period, there was a few things going on. One was rate cut expectations. The markets were already pricing in potential rate cuts that was expected to begin in September. So rate cut expectations during this period was very high. And also we saw the labor market start to soften while inflation was trending consistently lower. So we were in a period where rate cut expectations were high, while US labor market data showed softening, while we also saw inflation continue to trend lower, building up huge interest rate cut expectations, causing the dollar to lose rapidly even before the first rate cut took place. We can see here from end of June till the first rate cut, the dollar index had already lost 5.4%. So you can see here how markets are always forward looking. Markets are always looking at how the US macro data is evolving. In this specific period here, we had US labor market data as reported by the ADP private employment reports, as well as the uh, Bureau of Labor Statistics non-farm payrolls, which covers both government and private sector, showed job growth slowing down. We saw inflation continuing to trend lower, all raising high expectations of rate cuts, of a rate cut that would take place in September. Right, so you can see here high rate cut expectations, softer U.S. labor market data, continuous easing of inflation, already caused the dollar index to lose value even before the first rate cut took place. And all that reversed, right? Actually, the macroeconomic environment actually reversed quite drastically between 20th of June and September till and from September till the end of the year. During this period here, from end of September till um, the end of December. During this period, we actually saw CPI accelerate, right? As I mentioned, headline CPI and headline PPI accelerating, while we also saw the US labor market make a pretty good rebound as well. They didn't uh, highlight massively high job growth, but we saw pretty decent job gains over the final few months, which raised expectations of fewer rate cuts in 2025. So you can see once again how markets are always forward looking, right? How markets are always forward looking. During this period, US labor market started to rebound, consumer inflation and producer inflation both started to accelerate, dashing hopes of continued rate cuts in 2025. So that is why that's part of the reason why we saw the demand for the US dollar pick up aggressively. We also saw, of course, President Donald Trump back then being winning the US elections on 6th of November, in the first week of November. And with his elections and win combined with his potential policies had caused the dollar to rise rapidly as well as see US Treasury bond yields surge higher during this period. So you can see here, while the Fed was making 3 consecutive rate cuts, traders and investors were actually looking at the incoming and projected US macroeconomic data, specifically looking at the labor market and inflation, and how that would impact future rate cut expectations. So as you can see here, right, in 2025, the Fed has already paused at 4 of the uh, FOMC meetings this year, but all that price action actually took place well before that. So this is what I mean. Markets are always forward looking. So do not wait for the rate cut decision to actually take place before you take a position. Imagine at each of these 3 meetings, you decided to go short on the dollar index simply because on 18th of September, the Federal Reserve made a huge jumbo rate cut of 50 basis points, and then again 25 basis points on 7th November, and another 25 basis points on 18th of December. Now, on each of these dates, if you had just gone short on the dollar index, right, maybe on 18th of September and 7th of November, maybe you would have made a little bit of money on those shorts, but you could see price action reverse abruptly or reverse swiftly, and we saw the value of the dollar index actually jump significantly higher. So you can see here the dollar index actually surged 10% in the end of last year while rate cuts were taking place. Always remember, markets are always forward looking. Investors and traders are always looking at uh, the level of rate cut expectations, and they're also looking at incoming US macroeconomic data and projected data, right? Looking at how labor market trends and inflation trends are heading, and they are always moving ahead before the Fed actually uh, um, releases its statement and has conducted its monetary policy actions. So you can see here, right, markets are always forward-looking, and come 2025, as President Trump uh, was sworn into office, right, or was had his inauguration, right, we saw that he started to uh, drop notes or drop clues on potential tariffs that would be levied against US major trading partners. Remember, so all of that caused the value of the US dollar to lose significant value, right? So 2nd of April was Liberations Day, but even before that, the White House had already announced tariffs on steel and limited imports into the US in at the end of February, early March, right? And also some tariffs against its most immediate trading partners, basically Canada and Mexico. And finally, the big bombshell was dropped on 2nd of April. And by this point, investors and traders had lost faith in the value of the US dollar. The US dollar was no longer a safe haven asset or was not seen as a sign of strength, right? The US economy or the US was beginning to look as a sign of weakness in the global financial markets, right? And that caused the dollar to sell off rapidly. And over this same period, right, we also saw US uh, treasuries. Treasuries were also, US Treasury bonds were also being sold off aggressively along with the dollar. Now that brings us to the current situation where the Fed actually made a pause on the most recent meeting, but you can see here what is actually driving the value of the dollar index and the level of US Treasury bond yields is not so much the Fed action at each particular meeting, but rather what is going on in the backdrop of US macroeconomic conditions and the projected evolution of or the projected trends of the labor market and also of inflation trends as well. So if you're going to try to trade each interest rate decision based purely on the outcome uh, for by the Fed, right? If you just look, or if you just say, oh, rate cut, rate cut, rate cut, I should short. You can see here last year this would have resulted in a very bad outcome. Similarly, here during this period where the Fed actually paused on each at each meeting while they projected a pretty neutral or somewhat hawkish outlook, you can see that if you decided to go long, and in those instances, you would have been wiped out or you would have been on the wrong side of the trade as well, right? Because instead of going long, right, you can see the value of the dollar index actually dropped at, progressively along the way because investors and traders uh, had lost faith in the value of the US dollar due to uh, uh, President Trump's um, tariff policies and agenda. Now, so that brings us here. We can see now that the dollar index will continue to remain under pressure, right? As long as trade negotiations are not formalized, right? There's a lot of details that goes into these trade negotiations and trade deal frameworks, and it's actually going to be it would actually take months before we can see any official trade agreement or trade deal being signed off between the US and any of its major US trading partners. Although some trade frameworks have been approved, so to speak, but we don't have an official trade policy signed off just yet. So that still keeps the level of uncertainty relatively high, and that means the dollar is likely to continue to drop lower as well. Now, with that, let's try and identify some of the key technical levels for the dollar index in terms of support and resistances so that we can see how we can try and play or take advantage of the current situation, right? So you can see here very clearly, right, the dollar index has lost nearly 12% since middle of June, right, from peak to trough. We can clearly see a series of lower highs, lower lows. And of course, at the same time, we can see this index continues to trade underneath the red Ichimoku cloud as well. Right, so the red Ichimoku cloud moving downwards along with price action continues to highlight the strength of the ongoing bearish momentum. Now, there is, I would say, beginning from 12th of May, right, there's actually a pretty good ascending downward channel, then we can identify, right, there was a false breakout, right, at the beginning of the week, right, Monday, 23rd of June, this Monday, there was a false breakout that had taken place, right, with dollar index breaking out of the downward channel briefly, but we can see that as it returned back into the channel, we can see the downward momentum gaining further traction, and dollar index continued to slide lower, right, so you can see here, as long as this downward channel continues to remain respected, right, we are likely to see the dollar index slide lower. Of course, there can be some potential false breakouts along the way, and also we cannot rule out in the future of a real significant bullish breakout materializing as well. But for now, based on the current US macroeconomic conditions and the projected trends, right, we can expect the dollar index to remain uh, relatively depressed and is likely to continue to slide lower. Now, in terms of potential resistances and support, you can see there's a big gap here as well that has taken place between Monday and Tuesday. And this level here can be identified as a potential intermediate resistance barrier and a potential intermediate resistance barrier. And the first major resistance is looking at this level here, approximately around 99.24. So 99.24 is where I would identify the first major resistance for the dollar index. And this gap between Monday and Tuesday is typically what I would label as an intermediate resistance. Now, in terms of support, right, in terms of support, we're going to have to zoom out a little bit and look at the chart of the dollar index back in March of 2022. Now, back here, we can see the dollar index making three significant multi-swing lows, so very clearly strong support here. And we can definitely be using this multi-swing low in that identification of a major support level. So let's take a look at it here. This is the multi-swing low at 97.78. And this is pretty much where the dollar index stabilized last, 2 Thursdays and Fridays ago, right? You can see it's clearly bouncing off this level at 97.78. And as recently as Tuesday and today, Wednesday, the dollar index has stabilized around this level as well. So you can see here, right, dollar index has bounced off the support once more. So clearly this is not an area to be putting on any new shorts for the dollar index, right? You can see that's already bounced off this level once on Friday, 13th of June. And it looks to be bouncing off this level once again today, Wednesday, 25th of June. So this is definitely the worst place to put on any shorts. What we should be looking for is for the dollar index to retrace higher and perhaps look for the better entry, maybe where one of the first potential resistances could come in is at this intermediate level at 98.34. Now, before we go down into the 4-hour time frame, I'm just going to run the Fibonacci retracement on this downtrend here, right, starting from this swing high on 12th of May, going down to the swing low on 12th of June. When we look at all the fibs, we can see that the 38.2% retracement aligns very well with the first resistance, and 23.6% is somewhat in no man's land. So just keep the retracements that are relevant. Remember the Fibonacci retracement. Don't force the Fibonacci retracements onto the analysis unless it sits close enough or aligns very well with a predefined resistance or support level. Now, beyond this first major support at 97.78, how could we possibly identify the next potential support area for that? We're going to have to go back to the charts on January of 2022, right? We can spot a nice swing high resistance being formed here on 27th of Jan, a little bit of resistance here on 28th of Feb as well. Once this level got taken out in the first week of March, what was a previous resistance barrier could be a potential support. So that's how we are going to label or identify the second support for the dollar index here. Right, as you can see here, if this level or if the first support right at 97.70 does give way, perhaps at some point this week or maybe next week, right? The next major support for the dollar index is going to be coming in at 97.25, which is a pullback level. Now, for that as well, right? We can also spot a nice zigzag pattern here, right? We can see there's a nice zigzag pattern beginning from 29th of May to 12th of June and 23rd of June. right? So we can try to run a Fibonacci projection between this zigzag, right? So starting here, point 1, 29th of May, point 2, 12th of June, and third point, 23rd of June. The purpose of running this projection, of course, is to look for the key projection levels, which sit at 61.8%, 70.6%, and 100%. Now we can see 61.8% sits close enough to the first support, while 78.6% also sits pretty close to the second. So we're going to just keep 61 and 70% projections in our analysis here. Now, projections are basically telling us where we can expect price to eventually end up, right? We can see that almost right, the projection at 61.8% has almost been hit, right? It nearly got hit yesterday, Tuesday, 24th of June. So right now, it also tells us where we can expect price to sort of be able to find support. And similarly, and of course, if the projection level, of course, if it aligns close or lines up well with a predefined major support, it adds further significance to the strength of that support zone. Similarly, for this area here at 97.25, where we have the projection at 78.6%. Right now, now that we've identified the key support and resistance levels on the daily time frame, we've also identified the key, a very significant downward channel that has been in place since 12th of May. Let's move on down to the 4-hour time frame and try and identify or fine-tune the analysis if necessary. And as I mentioned, this level here has a big gap, right? Pretty decent intermediate resistance to be aware of, right? Oh, but before that, let me check something on the daily. Once more, I just want to quickly check something on the daily with regards to the RSI and dollar index. Oh, sorry, stochastic, right? Now the RSI indicator, which is the pane here, and the stochastic oscillator, which is the bottom pane, are momentum indicators. And when both of these indicators are in the lower thresholds on the daily time frame, they can typically indicate a pretty high probability oversold condition. So what do we mean by an oversold condition? That means when the RSI has dropped below 30, stochastic oscillator has dropped below 20, right? When both of these are at their respective lower thresholds, it would indicate a high probability oversold signal or condition. And what that oversold condition means, typically we would see prices to stop falling, consolidate, and maybe make a counter trend rally. Now, if we look at where the oversold conditions have taken place in 2025, right, we can see here, this area here between 11th of April and 21st of April, an oversold condition was being highlighted, and we finally did see the dollar index stabilize at around 98.25 before staging a pretty strong counter trend rally. This counter trend rally was as much as 4.1%, right? So you can see here, once an oversold condition such as this is spotted, be wary of putting on aggressive shorts, right? During this period here, be wary of putting on aggressive shorts, as we are quite likely to see the index stabilize and make a counter trend rally. Similarly, there was another oversold condition being highlighted here on 11th of March, right? We can see dollar index making like a double bottom, right? Pretty much on 11th of March and 18th of March before staging a small counter trend rally. Now, this small counter trend rally was just 1.35%, but nevertheless, this would have been the worst place to put on any aggressive shorts once more, right? So once we do spot a high probability oversold condition, typically we'll see that on the daily time frame, and that's when RSI is below 30 and stochastic oscillator is below 20, right? That's when we would really see uh, any particular instrument, in this case the dollar index, sort of stop falling any lower, stabilize, and perhaps make a counter trend rally. So take note, right? We don't really see any major or clear oversold conditions just yet, although we do see stochastic oscillator dropping as low as 9 since the beginning of June, but RSI has only managed to hit about 36, right? We're not seeing a very significant oversold condition as what we've seen between 11th and 18th of March, and of course between 11th and 21st of April, right? So take note of these oversold conditions as well on a daily time frame, because they really help us to prevent uh, aggressively chasing or shorting the dollar index here in the current situation. All right, so let's get rid of the vertical markers. Okay, let's keep it on for now. And let's now switch on over to the 4-hour time frame. Now, 4-hour time frame, right? We can see there's a nice downtrend beginning from this swing high here on 23rd of June. So we can try to run a Fibonacci retracement going down to the low of Tuesday, looking at all the fibs. We can see that a 38.2% retracement, so it's pretty close to the pullback resistance, right? Right, I would say this is a nice pullback resistance, and especially when I look at across this level here, 15th of June, right? Pretty decent pullback resistance, accompanied by the Fibonacci retracement at 38.2%. Right, and then slightly higher up, I can spot another overlap, I would say, right? There's another overlap here at 98.58, which is also accompanied by a Fibonacci retracement at 50%. So we can see here between the first support and first resistance, we have also identified intermediate resistances via sort of a pullback at 98.29 and a 38.2% Fibonacci retracement, and an overlap level at 98.58 and the 50% Fibonacci retracement. Now, we can see here, this is also, so should we see dollar index start to make a counter trend rally, and if it does fail within this zone here between maybe 38 and 50% retracements, right? If it does fail around this level and starts to make a bearish reversal and drop lower, perhaps this area here within this zone would be a pretty good uh, uh, area to keep an eye on for any potential openings for shorts as well, right? We could see, right, counter trend rallies taking place, and where we can probably expect the dollar index to run into a lot of headwinds would be between the 38 and 50% retracement. And at the same time, remember, the upper trend line of the downward channel itself can function as an area of resistance as well. So we've got the downward channel, upper trend line of the downward channel. We've got the overlap at 98.58 and a 50% retracement, and the pullback at 98.29 and a 38% retracement, identifying a pretty strong resistance area. And if we do see the dollar index climb back into this zone and sort of stall, this is where we probably have a better opportunity to go short on the dollar index once again, right? So take note, right? Looking for a counter trend rally on the dollar index, pushing it higher, perhaps into this zone here around 1950. And if you can stall around this level once more, right? Make a clear sort of like a top, right? Make a clear top. This is where we can probably get a good opportunity to go short on this index once again, right? Probably right now is not the best time to go short on the dollar index, despite it being in a prolonged downtrend. Probably wait for it to retrace a little bit higher, coming up into this zone that's highlighted here. All right, for those of you who are on Zoom, I'm just going to launch a poll as well. Really appreciate it if you guys can give your feedback with regards to today's webinar. And of course, if you have any questions, do let me know in the Q&A box. I'll be more than happy to go to answer your queries. Right, otherwise, if there's no further questions, right, thanks again for tuning in. Thanks once again for tuning in into today's session. And do look out for all upcoming webinars brought to you by Vantage for the remainder of the week, and of course next week as well. Right, I wish you all the best in your trading journey, and look forward to catching all of you at the next session. All right, thanks everyone. Take care. Have a great trading week, and catch you all soon.